Namaste and welcome to a presentation on transfer pricing. The concept of transfer pricing makes use of transfer price. Transfer price is a price which is charged by one division to the other when in a big decentralized organization, goods and services are transferred between divisions. The transferring division invoices the receiving division at a specific price, and that price is called transfer price, which is quite notional. And the purpose behind this is to evaluate every division as a profit center. It has to justify its existence by generating more than what it incurs. And in this regard, transfer pricing helps us measure the profitability of divisions. Second, when we are investing on a project, we want to know its profitability. Unless we use a notional value for its production or services rendered, we will not be able to decide whether it is giving the required ROI. In such a case, we make use of transfer price in estimation of the earnings of a project before we take an investment decision. And we are also noting that transfer price is used widely by multinational companies who have branches across the globe. What they do is, where the tax rate in a country is very high, they don't want their branch to be making heavy profits. Therefore, they will price them high. Whatever the goods they transfer from the head office to the branch of that country, it will be priced high so that their cost of production goes up, profitability comes down, they pay less tax. Contrary is done where the tax rate are low or neutral. It is a tool which is used, but it has got tax implications. And tax surveillance also will be very strict on these companies who have international operations. But it is a fact that transfer price is very actively used by multinational companies to manage the tax structure of both the parent and the subsidiary. And how is the transfer price derived? Transfer price can be derived on cost. When it is derived on cost, it can be actual cost incurred by the department or the division, or it can be cost plus a percentage. Say if you incur 100, you may charge 110 as plus 10% as the margin. Or it can be valued at standard cost. Standards evolved after scientific study of all inputs. Or it can be based on marginal costing also. Therefore, transfer price can be created out of costs, and it can also be based on market price. If a department is producing a product which is selling in the market at say rupees 10, irrespective of what it costs us, we may raise an invoice internally at the rate of rupees 10, which is the prevailing market price. Or if there are two departments of ours, A and B, the two departments can sit across the table and they can decide what should be the price to be charged by A to B when it internally transfers. That is a negotiated price. Then there is an opportunity cost which is used for transfer pricing. For example, you have got a department A which is selling in the market a product at rupees 100. Department B wants to purchase a part of the production internally. Then department A can tell them that we are selling the product outside at 100 rupees. We can transfer you at the same time because we need to have the opportunity cost concept. If I don't sell you, I can sell it in the market for 100 rupees. Therefore, when I give it to you, I will charge the same 100 so that my opportunity cost is taken care of. This is the fundamental concept of transfer pricing. And this helps the company to optimize the profits. It takes care of idle capacities, and it also takes care of the concept of opportunity cost. We have four sets of illustrations which we will be dealing here now. First illustration of the four will be based on fixed cost and production levels, and it will be quite interesting. This is a December 2017 question. A manufacturing company has got two divisions, division X and division Y. Division X is engaged in production. X is the producer, and division Y packs and labels the product and sells it in the market. It is the seller. Therefore, production takes place in division by X. Division X produces and supplies 25,000 units of the product per month. We have to need noting month. Per month 25,000, and therefore per annum 25,000 into 12, 3 lakhs. We generate that. That is produced and transferred to Y. Division X incurs rupees 16 as the variable cost. It incurs rupees 16 as the variable cost for the product, and fixed cost of 8,40,000. Fixed cost of 8,40,000. 8,40,000 for its full capacity. Therefore, for 3 lakhs, 8,40,000 means per unit we will be incurring 2.8. 8,40,000. X incurs 16 as variable cost for the product, fixed cost of 8,40,000. Investment in fixed assets. There is an investment of 9,60,000. The division plans to have 12% return on fixed assets. Means whatever operations the company does, it has invested 9,60,000. It wants a return of 12%, and we have to presume here it is 12% per annum. When it produces 300,000 units, it has to generate 12% on the investment of 9,60,000, which is 12% into 9,60,000 is 1,15,200. It becomes once again the expected return on investment. 1,15,200 has to be recovered over 3 lakh units. Therefore, per unit it becomes 38 paise. Totally, we have variable expense of 16, 2.8 of fixed costs, and 0.38 of return on investment of 9,60,000 at the rate of 12%. This is cost to cost transfer price. What department X does, it produces and transfers to department Y. And what should be the price now? It has incurred 19.18 and it will transfer at 19.18. What the problem says, the division plans to have 12% return on fixed assets as normal profits. That is taken care of. Division Y incurs rupees 10 per product as variable expenses for packaging and marketing. Means it receives 19.18 while selling per unit. It has received 300,000 units at 19.18. It incurs 10 rupees. Therefore, its cost becomes 19 plus 10 is 29.18. Then find the transfer price per unit of product division X can charge to transfer to Y, which we have already seen. What will be the profit of division Y if it can sell all the products in the market at 80 per unit? At 80 per unit, if we sell, our cost is 29, we make a profit of 50.82 per unit, and we are selling 300,000, means 300,000 into 50.82 is our profit, which is nothing but 152 lakhs 44,800. 3 lakhs into 50 rupees per unit, 152 lakhs 0.448 is the profit that we will be making. That is question for number 2. Then number 3, if the division can sell only 15,000 units per month, here we are talking of 25 into 12. instead of 25, if it produces only 15, what happens? It will have implications for two things. One, fixed cost remains the same and return on investment remains the same. This we have to take into account. If it produces 15,000 per annum, it is 15,000 into 12, 1,80,000, and variable cost remains the same. It was 16 before, now it will be 16, and fixed cost, the amount remains the same, 840. Earlier we were recovering it under 300,000 units. Now it will be only 1,80,000. 1,80,000 dividing 8,40,000 is 4.67. Then our investment remains the same. Return on investment has to be 1,15,200. 1,15,200 divided by 1,80,000, it is 64,000. We can note here, earlier it was 2.8, now it becomes 4.67 per unit. This was 38, this becomes 64. Now both put together, our total cost becomes 21.31 when we are producing only 15,000 units, and this is the price at which we will be transferring to Y. And whether it is 15,000 or 30,000, variable cost incurred while selling by department Y continues to be 10 rupees, which was there earlier. 21 plus 10, 31.1. If division Y sells 15,000 units per month and asks division X to supply only 15,000, what will be the effect on transfer price and profits of the division? Transfer price will be 21.31 plus 10, cost of sales will be 31.31, selling price will be 80, contribution per unit will be, profit per unit will be 48.69 instead of 50.82, and 48.65 into 15,000 will be per month into 12, that is 1,80,000 into 48 is 87,64,800 is the aggregate profit on 1,80,000 units. On 1,80,000 units, 87.6 lakhs. On 3 lakh units, it is 152.44 lakhs. Now to go back, answer to the first question, find the transfer price per unit of the product that division X can charge on transfer is 19.18 as we saw here. Number 2, what will be the profit of division Y if it can sell all the products in the market at 80? The profit is 15 point, that is 152 lakhs 44,800. Third, division Y, when it sells 15,000, what will be the effect on transfer price? Transfer price will be 21.31, whereas the profitability will be 87 lakhs 64,800. With this, we will have solved this problem of December 2017. The second illustration that we will be taking up is involving idle capacity. It's an illustration number 14. Let us straight away get into that. XYZ Limited has a system of assessment of divisional performance based on residual income. We have to understand residual income is nothing but the net profit which is budgeted. It has two divisions, alpha and beta. Alpha has a manufacturing capacity, annual manufacturing capacity of 15 lakh numbers of a special product. Now we have to be very clear. There are two divisions, alpha and beta. We are dealing with only alpha. Alpha is the manufacturing unit. It has got a capacity of 15 lakhs numbers of a special component that it sells to outside customers but has a idle capacity. Okay, we recognize there is an idle capacity. The budgeted residual income of beta is 120 lakhs, whereas alpha is 100 lakhs. We are concerned with alpha, not beta. Therefore, our target profit is 100 lakhs. If we note this, we can go further. Other relevant details are extracted from the budget of alpha for the current year are as follows. Sales 12 lakh units out of capacity of 15 lakhs, 12 lakh units is being sold at the rate of 180. 12 lakhs being sold at 180 and variable cost per unit is 160 and divisional fixed cost is 80 lakhs and capital employed is 750 lakhs and cost of capital is 12% and we have to presume this is 12% per annum and this is an annual turnover we are talking of. 12% of 75 lakhs. Now let us get going. If your capacity is 15 lakhs and if you are manufacturing 12 lakhs means you have an idle capacity of 3 lakhs. Then you are selling at 180 and your variable cost is 160 means you have got contribution of 20. You are selling 12 lakh units at the rate of 20. Therefore, contribution is 240 lakhs is the contribution. 20 into 12 lakhs. Fixed cost is 80 lakhs and cost of capital 750 lakhs into 12% is coming to 90 lakhs. That 90 lakhs we will be adding as amount to be recovered. Means between fixed cost and cost of capital 80 lakhs and 90 lakhs we have to recover 170 lakhs. We have got 240 lakhs as the contribution. Fixed cost is 170 lakhs means the profit from the order is 70 lakhs. We have to just remember one thing. We have earned 70 lakhs whereas our target for the year in respect of alpha is 100 lakhs means there is a gap of 30 lakhs. In target there is a gap of 30 lakhs. In capacity there is an idle capacity of 3 lakh units. Just remember this at the back of your mind. Now what it says, beta has just received a special order for which it requires components similar to the ones made by alpha. Beta is the marketing wing. Fully aware of the idle capacity, beta has asked alpha to quote for manufacture and supply of 3 lakh numbers. Beta has placed an order for 3 lakhs for selling in the market and we have got idle capacity of 3 lakh. Means we can take the order, but at what price? With a slight modification during the final processing, when we take up production of these 3 lakh units, there will be a small variation which will take place in our variable expenses. Extra variable cost of 5 will be happening. If we are incurring X as of today, we will be incurring in future X plus 5. If we take this, we can get going. New order from beta is 3 lakhs. Variable cost, we know for sure our variable cost in the normal course is 160. And as per the problem given, there is an additional expense of 5 per unit as additional variable cost. We have no fixed costs because they are already covered here, but we have got a gap in residual income. Out of 100 lakhs, we have covered 70 lakhs. We have a gap of 30 lakhs. That 30 lakhs we have to cover on these 3 lakh units. 30 lakhs divided by 3 lakh per unit, I need to cover a profit of 10. And if I take that way, 10 lakhs residual income, 70 lakhs already covered, 100 lakhs residual income, 70 lakhs already covered, 30 lakhs is the balance to be recovered on 3 lakh per unit 10. Therefore, my transfer price will have 3 components: normal variable cost, special variable cost, and differential residual income of rupees 10, and my price will be 175. To answer the question, the transfer price which alpha should quote to beta to achieve its budgeted residual income is 175. Means residual income we will be getting 70 lakhs from the regular operations, plus we will be getting 30 lakhs from the sale of 3 lakh units. and the price here will be 175, and in the previous case the price will be 180. The price will be 175 for the simple reason fixed cost is already covered by the regular production. This is making use of idle capacity. Now we are taking up an illustration where opportunity cost on a single line of product is involved. It is illustration number 16, very simple and easy to understand. Division A is profit center that produces three products, X, Y, and Z. Division A, it has got three products X, Y, and Z. And each product has external market. It can be sold outside. And external market price per unit is 48, 46, and 40. Variable cost of production per division is 33, 24, and 28. Labor hours per unit is, now before going to labor hours, we can just say 48 is your sale, variable cost is 33, 48 minus 33 is 15 is the contribution, 22 is contribution, 12 is the contribution per unit. Then labor hours per unit is, per unit we require 3, 4 and 2 hours for X, Y and Z. And then we can see how profitable they are. X gets 15 contribution on 3 hours, means per hour the contribution is 5. And in case of Y it is 5.5 and Z it is 6. Why we are doing this is to reward the limiting factor. Hours is the constraint and each unit used in Z gives 6, Y gives 5.5 and X gives 5. If we have to do rationing, first rank goes to Z, second goes to Y and third goes to X. This is how we will allocate the hours. Maximum external sales units are 800, 500 and 300. Now, if we are producing so many units and per unit if we need so many hours, how many total hours are required? We require 3 into 800, 2400, 4 into 500, 2000 and 2 into 300, 600. 2600 plus 2400, we require 5000 hours. This is up to this stage. Up to 300 units of Y can be transferred to an internal division of B. Means we can transfer up to 300 units based on an internal demand. Then what does it say? Division B has also an option of purchasing the piece at a price of 45 per unit. Means these 300 units can be either manufactured inside the company or it can be bought from outside at 45. But the constraint with us is we have one situation where we have got 3800 hours and we want to manufacture 300 units for internal purposes. How do we do that? Let us take the first situation. 300 units are required. Its external price is 45. And if there is 3800 hours with the company, how will we ration between the three? First, we will give full requirement of A, Z, because it is ranking 1. We will give full requirement of 2, which is ranking 2, product Y, it requires 2000 hours. Out of our 3800, 2600 is gone for the best profitable units. Balance will be given, that is differential will be given to X. Now let us understand. If we do like this, how many units we can manufacture? We have got per unit how many hours are required. And we can calculate for 600 divided by 2, we produce 300 of Z. For 2000 we require 4, means we produce 500. And in case of X, we have given the balance 1200. 1200 divided by 3. Each unit requires 3, 400 units. Now, it is required to see when we do allocation like this, how much contribution we are getting. Contribution in respect of the 3 units are 12 in case of Z. We have done this. 12 in case of Z, 12 into 3, 3600, 22 into 5, 11,000, and 15 into 4, 6,000. Now, this is the contribution that which we are getting. Total contribution generated is 20,600. Now, this doesn't solve our problem. We need to produce 300 and our capacity is limited. We have to take this 300 units by removing from X, Y, or Z. In a company, if it has to retrench somebody, they will retrench the least profitable or least productive person. In our case, X is the least profitable in terms of contribution per hour. Therefore, our focus will be on X. We need 300 units of Y. If you want to produce 300 units of Y, per unit of Y, how many labor hours required? 4. 4 into 300, we require 1200 hours for production of extra 300 units of Y. Do we have this 1200? If I have to take from Z, it is not worth it. Y not worth it. I can take it from X, which is least profitable. Therefore, I will stop producing X. And I have got 1200 units here, which was producing 6,000. I will use those hours and transfer it for production of Y. Means when I transfer these hours, I lose this profit, which I was earning when I was producing X. What transfer pricing says is, you have got an opportunity cost. If you had used it here, you were earning 6,000. When you produce Y also, you should earn a minimum of 6,000. It becomes an opportunity cost to be earned by the new product of 300. Therefore, hours 1200 and contribution we have to earn 6,000. What happens to the cost structure? When we do Y, Y has got a variable cost of 24. And Y has to make a profit of a minimum of 6,000, which is the opportunity cost contribution. Therefore, 6,000 divided by 300 is 20. 20 rupees per unit is nothing but the profit it has to make or contribution it has to earn. Therefore, the total cost of it will be 44. As compared to the market price of 45, we can offer to them by producing 300 of Y after closing down production of X, but our profit will remain the same. We stopped X, but we are recovering it in Y. Still, we are able to give them at a price lower than market price. Therefore, division B will buy from us because for them it is 1 rupee cheaper. If they get it from outside, they have to pay 45. Here we are giving it 44. They save 1 rupee. For us, profit of 20,600 is retained just because whatever we lost by shifting hours of X, we have added it in the price of the 300 units. Now coming to the second one. This is when your production hours were 3,800. What happens if you have 5,600 hours? Let us take that case. If there is 5,600, we know that the maximum that we can sell of each product is already given, 800, 500 and 300. In that case, the hours required are 3 into 800, 4 into 500 and 2 into 300. Total requirement is 600 plus 2000 and 2400. Total is 4,400, 5,000 already covered. We need 5,000 hours for producing all units as per standard. But today I am having 600. 5,600 means I have got surplus 600 hours. Then how should I do? For producing Y, I need 1,200 hours. How do I get that 1,200? I already have 600. Balance 600 I will take out of X because that is the least profitable. If I do that way, out of 2,400 hours, I will shift 600 hours from here to here. When I do that, for 1,200, how much profit we were doing? 6,000. If I transfer 600 out of 1,200 hours, then we also have to get their profit. Half of it is transferred means I need to get 3,000 as the minimum contribution in respect of 600 hours. We will go ahead. We have extra 600 as per the capacity. We were short of 600. We transferred from X. When we transfer X, we need to transfer the opportunity cost of half of the capacity. Because its capacity is 1,200, we transfer half. Therefore, 3,000 out of 6,000 is the cost, opportunity cost. Now, we have got, in respect of this additional Y, what is the variable cost? Variable cost is 24. And when we transferred, we have to transfer half of profit of X, 3,000. 3,000 over 300 units is 10 rupees is the contribution, that is opportunity cost. Total required transfer price will be 24 plus 10, 34. And the reason why it is going down is because this is idle time. It doesn't have any opportunity cost. 5,600, 600 is extra. It doesn't have profit target, whereas the 600 which we are getting from X has got a profit target. Therefore, in respect of A, for 3,800, transfer price is 44. And in case of 5,600 hours, since 600 hours is idle hours, the profit target will be 3,000 instead of 6,000. Therefore, the price will be 34. We will take up one more illustration involving opportunity cost with multiple options. This is December 2019 example. Division Z of Starex Limited is a profit center which produces 4 products A, B, C, D. And each product is sold to external market. Following are the data available. Market price per unit 600, 580, 560 and 510. Variable cost 520, 400, 360 and 335. As in the previous problem, derive the contribution 600 minus 520, 580 minus 400, 510 minus 335. This is the contribution. Labor hours required per unit 3, 4, 2 and 3. Once we do it, let us see the contribution per hour. This is per unit hour. This is per unit contribution. 80 divided by 3 per unit per hour. The contribution is 26.7. 180 divided by 4, 45, 200 by 2, 100, 58.3. Limiting factor is labor hour. Therefore, based on that, we do the ranking. Product C, rank 1. Product D, rank 2. Product B, rank 3. Product A, rank 4, because the contribution is the least. Having known this, we do the ranking. Then we go ahead. Product D can be transferred to division Y, but the maximum quantity that may be required is 15,000 units of D. They want additional quantity of 15,000 units of product D. Existing D will continue. They want additional 15,000. The maximum sales in the estimated market is A 16,800, B 15,000, C 13,800 and D 9,600. What will be the hours required? Let us see. For 16,800 per unit 3, 50,400, 4 into 15, 60,000, 2 into 13, 27,600, 3 into 29,600 is 28,800. What we require is, to cater to the existing market, we require 1,66,800. Division Y can purchase the product at rupees 500. It can purchase at 500 instead of receiving transfer of product D from division Z. Agreed. That is a matter of fact. What should be the transfer price? For each unit of 15,000 units of D, if the total labor hours available is 1,20,000. Our requirement is 1,66,800 and we have got only 1,20,000 hours. Now, once it is 1,20,000 as against 1,66,000, that is the limiting factor. We do the rationing. First rank give fully 27,600. Second rank give fully 28,800. Third rank give fully. We are left with 60 plus 27.6 plus 28.6. Balance remaining will be 3,600. Balance will be given, residual balance, to the last rank holder A. Now, if this ranking is done, how many units can be manufactured? Full units will be manufactured in respect of these three, and units available in A is only 3,600 divided by 3,200. Now we derive for 1,20,000 what is the contribution. 1,200 into 26.67 is 96,000. 15,000 into 45, 27 lakhs. 13,800 into contribution is 200. 200 into 13 is 27 lakh 60,000. 175 into 9,600 is 16 lakh 80,000. Total, we are getting a contribution of 55 lakh 56,000. But of all these, what is relevant is what is the opportunity cost for transferred hours. Simple. We have to produce additional 15,000 units. Now these 15,000 units of D, each unit requires how many hours? 3. Means for 15,000 we need 45,000 hours. 15 into 3 is 45,000 hours. Now these 45,000 hours cannot come from, it has to come from the least profitable division. Least is A. A has to fully close and give its hours. How many hours they have? They have 3,600. We take their 3,600 and we also take their opportunity cost. 96,000 we have to earn. Now our requirement is 45,000. 3,600 is gone. Balance is 41,400. We have to come in that order. This is rank 3. They have 60,000 hours. Out of 60,000 hours, we are going to take out 41,400 hours. If we take out 41,400 hours, what is the profit they are doing? 27 lakhs for 60,000. Proportionately, we have to also get their opportunity cost. 27 lakhs divided by 60,000 multiplied by 41,400. When we do that, this can also be done by contribution per labor hour, 45 into 41,400. It is 18,63,000. Means to produce Z, produce additional D for Z, 15,000, we need 45,000. We can take that from the two least profitable departments, Department A and Department B. From A, we get 3,600. From B, we take out 41,400. We commit to earn their opportunity cost of 96,000 and 18,63,000. Totally, it becomes 19,59,000 and 45,000 hours. Now, we can note this 96,000. In case of B, it is 45 hours, 45 per hour into 41,400. Total of these two, 18.6 plus 0.96 is 19.59, is the opportunity cost in respect of 45,000 units. Simple now. We have got variable cost for D. We know variable cost for D is 335. And we know opportunity cost is 19,59,000 to be recovered over 15,000 units. 19,59,000 divided by 15,000 units per unit, the cost comes to 19,59,000 divided by 15,000 is 130.6, and the total cost comes to 465.6, and market price is 500. Now here what we are trying to say is, when you want to produce against a specific order, you have to take into account the profitability of the sacrificing products, and you have to recover at least that profit or that contribution, which in this case is 19,59,000. For 15,000 we have to do this, plus we have to recover the regular variable expenses. Variable cost of production is 335. 335 plus 130 is 465. And that answers the question, what should be the transfer price for each product of 15,000? Transfer price has to be 465.6. That and we have considered the 4 problems. Hope you liked the presentation. Thank you so much. Thanks a lot.